Hello, everybody. So today I'm classifying stocks in a different way. I'm going through my spreadsheet and I'm screening a bunch of stocks. And I typically screen stocks based on their sector. I do things like SaaS, like AI, like solar, like payments, like software stocks, right? And I present which is the best in each category. Sometimes, and in the past I've done it twice, I've done it for Brazil and I've done it for China. Sometimes I try to cover stocks based on their countries of incorporation, based on where the companies got started. And today, I am going to be looking at Israeli stocks. You would be surprised how many stocks come up in my other spreadsheets that were founded in Israel and that are still run from Israel. So before I go on, in the comment section, this is a stocks video. We discuss stocks on this channel. I just want to make that point very clear. So why Israel? Why would we want to classify stocks on Israel? Well, because a lot of innovative companies hail from there and they come up in the spreadsheet. Like whenever I do a spreadsheet, I often have one stock from Israel in that spreadsheet. So that's for point number one. Point number two, there is a link between innovation and Israel. And actually, if you've been in the world of business for a long time, or if you read a lot, you've probably read this book before. This was a very popular book called Startup Nation: The Story of Israel's Economic Miracle, talking about how they did it, right? And actually, when you read that book, a lot of the parts of that book are very similar to the United States. They talk about immigration in that book. They talk about the influence of a high proportion of military, service skills, leadership. Of course, the U.S. as the largest military in the world. So there's some similarities in that book that I think made it interesting. It's an old book now, but it used to be a bestseller in business, and that may explain why there's kind of a mini Silicon Valley over there. And another thing I want to say is that I'm not the only one who's noticed that classification. In fact, Cathie Wood, Cathie Wood is like, the queen of innovation, as they call her online, Queen Cathie, as they call her online. She has had, since 2017, she's had a themed ETF only around Israel innovative stocks, right? And you feel free to look up and see which companies she has in that ETF. Actually, it's worth mentioning, if you compare the Israel ETF from Cathie Wood, it's performed roughly in line with her other ETFs, at least in the past 5 years. If you go to a longer time frame, Israeli stocks have underperformed their own stock picking. So I'm not necessarily advocating for picking a stock based on the country. That's definitely not what I'm doing here. I'm just saying it's a good starting point for a spreadsheet and to analyze the companies and kind of see where they come from. So today I'm only covering stocks that were founded and that are operated from Israel. And this is the spreadsheet we got. So you see what I meant. That's a lot of stocks. And by the way, there's many more than that, but this is only those that I think are interesting for this channel, for us to discuss in this channel. And you will find some familiar stocks in there. Some of them you've asked in the comment sections. Others I've covered on my own. So let me get started. The first stock, and I own this one. I have a very small position in this one, but I own it. It is INMode. So INMode is a startup. Well, it's not a startup anymore. It's really it's a bigger company now. But they specialize in low invasiveness cosmetic surgery. So they kind of sit before the intensive surgery, before where they have to put you to sleep and do things like a liposuction, etc. They sit right before that. So they're a step above of, say, like a Botox, but they're like a step under a full surgical procedure, and they are operating in the beauty space, right? So they have these machines. There are these $80,000-$90,000 machines. They typically have needles. They call the technology micro needling, and with that you can tone your skin, make some fat disappear, and whatnot, and whatnot, and whatnot. And they have something like more than 10 different machines that do that, and they do this in cosmetics, offices, etc. Now, this company, what's worth mentioning about it is that they have struggled recently because of the interest rates, because these machines, right, these offices that are going to buy those machines, the doctors who buy those machines, they don't have just $80,000 sitting around to buy a machine. And so their sales have greatly slowed down. And I think as soon as the interest rates drop, all of a sudden the cost of these machines will be much more appealing to these offices. So that's the reason, kind of the same reason as why solar, we'll get to Solaredge later, kind of the same reason why solar has also, seen a significant drop in sales. But nonetheless, they have a very profitable recurring business at InMode in those micro needling tips. The tips, they are rechargeable tips, and they are expensive. They're something like $100 for a disposable tip for those machines, and that explains a lot of that margin. 82% gross margin. Look at that EBITDA margin, 32% EBITDA margin, the second most profitable on this spreadsheet, the second most profitable stock on this spreadsheet. Of course, since this company is only predicted to grow at 1% in the next year, their sales, they do horribly in my EV over gross profit over revenue growth number. But the question is, when you buy a interest rate sensitive stock, the question one needs to ask themselves is, what is the growth going to be 5 years from now when the interest rates are low again? And I believe they will go back to their trajectory of 20 to 30%, which is what they were at before the interest rates got raised. Right now, they have a rule of 33, so not quite the rule of 40, but that's because they grow at 1%, right? Much of that is EBITDA margin. If they grew at 30%, they'd have a rule of 60. So I still own the company. I haven't consolidated yet. I might be making some stock movements and buy a little more, but this is a company that I'm owning for the long run, and I think they have a very interesting niche in their sector. Moving on to somewhat of a related sector. It's the beauty sector again. This time, this is the makeup world, the foundation world. This is Oddity. This is a stock that I like right now, that I'm actively buying right now, and that I'm building a position on. I call this stock as kind of HIMS, but HIMS for beauty is the way kind of how I would compare it. So the main product is called Il Maquillage. It's a foundation that's very popular on social media that uses AI to measure the exact color of a woman's skin, and then it makes a foundation product that is that same color, that exact color. And once a woman finds a foundation, they're more likely to come back and buy it again and again and again, because if you find the right color, you've probably gone through a lot of other products and you don't want to take the risk. So they have a recurring business model, a recurring revenue business model. More than 50% of their revenue is recurring. This company is still growing at 33%. They have new products coming up, and look at that EBITDA margin, 22% EBITDA margin. So they're nicely cash flow profitable. The gross margin is excellent at 72%, right? It's cosmetics. Cosmetics are very profitable, and they achieve a rule of 40 at 55. So that's pretty outstanding. And on EV over GP over revenue growth, by virtue of the fact that they're growing at 33%, my spreadsheet is giving them a very low cost per 1% of growth at a 0.11. So this is just above a HIMS. This is just under a Stonier, which is a Brazilian stock that I like, but just above a HIMS, which is, as far as these spreadsheets go, I haven't found a stock that scores as well as HIMS on this spreadsheet. So Oddity I like very much. Let me move on to another Israeli stocks that my viewers have given in the comment section, and it is Fiverr. Fiverr used to be a darling of the stay-at-home world of the 2020s. Right now, Fiverr has kind of been, I don't want to say it like that, but maybe a punching bag of anybody in AI. People saying, oh, well, AI will disrupt Fiverr, and it's true that if you look at that statement on face value, it sounds about right on face value. You really have to dig deeper to say, oh, well, people want the human touch. You don't want an AI generated picture, or you want to use someone on Fiverr who is good at Photoshop, right? But on face value, a stock like Fiverr, in my view, is endangered by AI. that's because I haven't dug deep enough into that question, because the valuation is just not there for me to be interested. So I'm not going to expend a lot of energy to figure out if that's true or not, because it's only growing at 8%. So it's not growing fast enough. The EBITDA margin is just under 0, so it's negative EBITDA margin. The rule of 40 is a 7. That's the worst out of all of the stocks. And yeah, that future growth is cheap as the 0.24, but there's also nothing to speak of. It's only 8%. So I don't like it as much. They better return back to growth. It's fine to have a company that grows only at 8%. But if they do, they better have a 30% EBITDA margin, right? And I guess this is a great example for the next company, which is Checkpoint. So this is a cybersecurity company in the cybersecurity space, only growing at 5%. But you can see that's okay for this company because they're optimized for profits, right? They have EBITDA margin of 37%, gross margin of 89%, okay? And the rule of 40 is a 42, so they're still above the rule of 40. So if you add up 37 plus a 5, you get a 32. That's your rule of 40 right there. So this company checks a lot of boxes. The only box that it doesn't check for me, unfortunately, is the valuation. It's nosebleed, 1.64. That's a nosebleed valuation. And of course, maybe some of it has to do with the fact that it's growing at 5%. But cybersecurity is not impacted by interest rates like InMode, right? Like InMode, I'm pretty darn confident that those machines, surgeons, doctors are going to buy those machines again as soon as rates drop, right? Checkpoint is cybersecurity. It's recurring revenue. Cybersecurity is resilient. It's always in need. And so I don't think we're going to have a 10 or 15% coming up. And so that's the normal price. That's an expensive company in my humble view. Now, let me move on to a stock that I've covered once in my software and SaaS plays, and it is Monday.com. Now, this one, I must say, I am impressed by the software. I've done a little research on that software. That software is outstanding. You can build entire apps on it. You can build the entire back end of an app for, I don't know, IT tickets, for, I don't know, project management of some sort. And you can have an entire website that you can build, internal website for your company. It seems to me like this would replace a lot of apps that are already out there, right? I'm thinking about apps, for example, calendar apps to take meetings on, apps such as the Dropboxes of the world, all of these apps that sometimes are included in software packages. It seems like a lot of companies can build very custom apps on Monday.com. So if I were to group this in a sector, Monday.com, I would group it in the low-code, no-code movement of software companies these companies that just don't use code anymore. And there is quite a few of those out there. I've watched a few demonstrations of the software. I was thoroughly impressed. And I am not surprised that it's growing at 33% revenue growth next 12 months. And the company, they're not optimized for EBITDA margin just yet, but they're not losing money, which is fine for me. That's all I want. They're clearly reinvesting in that revenue growth, and they're doing well on that revenue growth. The only downside that I see for this company is, and I guess it's the price. It's a 0.43, but I know a little bit about that sector. If you were to compare Monday.com to the peers of Monday.com, it would be right in line with the peers, perhaps on the cheaper end of those peers. So I think it's more of a question of do you want to be invested in no-code, low-code software SaaS companies? Is that a sector that interests you, or is that a sector that doesn't interest you? And I know it's a sector that interests me, right? I like Datadog in that space, for example. Although Datadog has a little bit of cybersecurity aspect to it, I like that company very much. There's a few over. I guess in that play, I'm mostly invested in cybersecurity, in cybersecurity SaaS. But Datadog is a stock that I think would trade just about in line with Monday.com. So it depends if you're interested in that sector or not. So this one is a dark yellow, perhaps almost a green flag, like a light green flag for me. Definitely warrants its own video, if only I had the time. Moving on to a stock that is an absolute no, Mobileye. Nope. Sorry, but this is, I mean, first of all, you're dealing with Tesla as your main competition, right? Mobileye is self-driving equipment that they sell, and they went the route of cameras and stuff, and Intel has a big ownership in it still. The other day there was a rumor that Intel would sell some of it, and so of course the stock tanked. The revenue growth is not there at 5%. I mean, I guess it's the only pure play in the self-driving thesis, but the market is clearly telling us something about it, and in my view, I would not bet on that company. Gross margin is only 47%. EBITDA margin is negative 7%. So you can't even calculate a rule of 40 because it's negative. So you're at minus 7% and you have 5% growth. You're negative on a rule of 40. So yeah, I would stay away from that one. Kudos for them trying. There was some optionality back in the day, I think, when we didn't know who was going to win. But in my view, it's very obvious that the camera-only approach of Tesla, the nothing but nets approach of Tesla to self-driving, in my view, it's very clear it's going to win. And so that's why I wouldn't touch it. That's just my own opinion. Now, let's talk about a sector that I don't know much about, which is the defense sector. The only reason why I put this one in there is because I've seen it in innovation channels and in innovation talks before. I'm pretty sure Cathie Wood owns it in her aerospace ETF as well, into her space ETF, ARC-X. So this is Elbit Systems. This is a defense company, like a classic defense company. I don't have much to say about that one. I think it would be much more agile than, say, a lot of the military contractors that we have in the US. Those Raytheons, those big companies. So I think they have that going for them. But my approach to defense is Palantir. I mean, my only defense play is Palantir, and Palantir is also a software play, obviously, as we well know. And Palantir, I took back what I put in it. I sold a little bit to recoup my investment, and now the stock is just going to ride on its own, and I am never touching it again. I'll see you in 10 years, see you in 15 years, and we'll see if Palantir is the next Tesla or not, as some Palantir YouTubers really believe. I'm on the train. I'm fine with just one defense play. I don't need two, so that's why I wouldn't touch it. But nonetheless, if you're interested, it's worth mentioning that they are one of the innovative stocks in Israel. Wix.com. Okay, so Wix.com, going back to 2020, this one was very popular in the 2020-2021 growth stock craze of America, as I'm going to call it. This stock reached nice heights. Unfortunately for me, I can't get excited about this stock, right? The growth, and Wix, by the way, if you're not familiar, it's a low-code, no-code website builder. That's it. And you can build your website there, and it's low-code, no-code. Personally, I am not as impressed with Wix and with the sector. I guess before I even tell you about the numbers, Wix, the sector, doesn't impress me because I see more and more businesses who just have an Instagram page, who just have a Google page, who just have a Facebook page, depending on who they cater to. And they don't necessarily have a website anymore. I think a lot of businesses today, small businesses, are doing away entirely with businesses, right? They just have a page on Amazon. They just have a page on Google. They just have a page on DoorDash and Uber Eats if they're a restaurant. I think a lot of businesses are doing entirely away with websites. And so if that's going to be the way of the world, then what if we move to a world where really it's AIs who do everything, and really what leads, 5 years from now, maybe most business will be done through AI APIs, talking to other AI APIs. So then what good does it do to you? So maybe I'm entirely wrong, but I think website is a very 2010 idea. Building your website is a very 2010, even 2005 idea. and I would like to invest in things that are more at the edge of innovation. So that's why I'm out. I could also be out based on the numbers. The EV over gross profit or revenue growth for that company is expensive at a 0.61 for a sector that I'm not too fan of. The rule of 40 at a 17 is low, right? Okay, they have positive EBITDA margin at 4%, but the revenue growth is 13%, so it's lower than the money dilution of the dollar. The dollar, new dollars issued are going at 15%. So, and I don't see how it would accelerate. Websites are not going to be the next big thing. They were the big thing in 2010s. Websites, in my view, they're only going to be a lower part of the internet, a smaller part of the internet. The internet is growing through more centralized networks, centralized apps. So that's why I would not invest in WIX personally. Pagaya. So Pagaya, I need to do a full video about it. It's in the payments space. It's in the banking space. I need to do a deep dive. I know I covered it a few times on the channel. I'll just speak about the numbers on this one. Revenue growth 16%, still low, but higher than 15%. So checks the box, right? Gross margin is decent for that sector. Actually, the EBITDA margin, I'd like to see it a little higher. It's a 0.25, so it's a decent grade on my enterprise value over gross profit or revenue growth. It's actually pretty good. But if you go to the rule of 40, 5 and 16 equals 21, but just won't cut it. That's just not high enough. Keep in mind, I can buy a HIMSS, right? That has a 55%, an 82%, an 11%, and that is 0.06, and that achieves a 67 on rule of 40, right? Or in this, Oddity, like if you compare the numbers of Oddity is better across the board, right? And Oddity is perhaps in a sector that I like better because it's in makeup, and makeup is as old as, say, Egypt. Makeup has existed since ancient Egypt. So if, the quote-unquote engineer in me tells me the Lindy effect, makeup has been around for 3,000 years. Makeup is likely going to be around for another 3,000 years. That's kind of my engineering way of thinking, right? Payments, banking, yeah, it's if there's crypto someday, so that's coming, and so that's why I want to only invest in the best. I like some payment stocks, right? I like Shift4, I like Stonier for a specific country play. I need to study it a little more to have conviction. I am not buying this stock. I would not buy this stock right now. Same for Similarweb. So Similarweb, we intuitively see it often on Twitter, right? A lot of people just type whatever company they're investing in and they show you, oh, look, the website traffic has increased on their website, and they do a screenshot of Similarweb. So they have their niche. It's kind of the competitor to Google Analytics, but a more open, easy access by third parties, at least competitor to, say, a Google Analytics. Their growth is in line with monetary printing. 79% gross margin is excellent. Unfortunately, that EBITDA margin is negative, but it's not that negative. It's -1%. It's just that I'd like to see it positive. It's cheap on EV over GP over revenue growth. The rule of 40 is unexciting at a 13. So, decent, I guess, but still a yellow flag for me. I would not be investing in this company. Now, Cellebrite. So Cellebrite is a IT company that helps government, helps the police. It's kind of similar to, what's the name of that company? I have it. That leading company, the company that made Taser. I can't remember the name of it. The company that made Taser is very similar to that company in Axon. It's similar to Axon in the US. At least that's the peer that I would compare it to. It's expensive at a 0.53. Why is it expensive? It's expensive because they sell to governments, right? Governments always pay their contracts. Governments pay. So that's why it's a little more expensive. The growth is good at 19%. I'd like to see it at 30%. But it's 19%, so it's fairly good. The gross margin is high. Overall, however, for me, it doesn't make the cut. I think it's too expensive, and I already have my defense/government contractor/security play covered in my portfolio through Palantir, so I would not touch that one. Now, a stock that I would definitely not touch, and I bought Solaredge I bought very little of Solaredge. What is it? Was it 11 or 12 months back? And I sold it 3 weeks later. And I regretted buying it. Because as you know, on this channel, I've been end phase all the way. End phase. I may have annoyed my viewers with end phase. So much I'm a fan of end phase, right? I think end phase is the best play in the solar sector. Solaredge has string inverters. String inverters, you get a lot of competition from German manufacturers. The SMAs of the world, the Fronius of the world. Those German manufacturers are really good at making string inverters, and they're driving the costs down. Right? It's a heavy industry product, a string inverter. I much prefer the microinverters, which are semi-based and where Enphase is the absolute leader. They have a 90+% market share, and so that's why I much prefer Enphase. Bought a tiny bit, sold it, and I haven't touched it, and I haven't looked back in 11 months, and I'm all the way Enphase, all in on Enphase. I wish luck to Solaredge, but the reason why I don't like Solaredge is because string inverters right now, they make more sense for commercial sector and commercial roofs and commercial buildings of solar, right? It's an inverter. If you don't know that sector, Solaredge makes inverters, right? Converting current from DC to AC current. String inverters, in my view, they're a legacy technology. They still work great for commercial. There is only one problem, is that the amount of commercial roof in the world is much lower than the amount of residential roof. It's a much smaller market to cater to commercial. The big market is in residential, in my view. So that's why I do not touch Solaredge. And let me conclude with GLBE. So this is an international logistics / payment company. A few people in the payment space like GLBE. I've seen it circulate in different areas. It's growing nicely at 32%. The gross margin is high at 43%. EBITDA margin is good at 11%. There's a lot to like. If they have Rule 40 at 43, the only thing, and I'm going to be a valuation snob here, is a 0.59. I think it's expensive. I think there's a lot of options where you can pay less for that growth, for that future growth. You can pay less than expensive sector. And therefore, I am staying out of it, knowing that I already have a lot of payments plays, so somewhat related to GLBE, which is why I am staying out of this one. So, this was not investment advice. This was no financial advice. This is it for my 13 Israeli growth stocks. You can see my conclusion is I like InMode. I like Oddity the most, and I'm interested in Monday. Monday, I'll be making a video. All of the rest, they're fine companies, but I tend to only want to look for the best. I'm only interested in the best. So, no financial advice, no investment advice. This is just entertainment. Please like, please subscribe, follow me on X if you can. Thank you for watching and have a wonderful day.